Good afternoon, everybody. My name is Garrett Schmidt. I am the managing editor for ACOexhibithall.com. And thank you all for joining us today for today's webinar that's hosted by Allianz Healthcare Capital. And it's called the Working Capital Options for ACOs. And this is an important topic, and these guys are definitely experts in the field. So hopefully they'll give you some great ideas and some tips on what is necessary to really have success there. A few items of note before we get started. All of you have joined today as attendees in listen-only mode, so you don't need to worry about muting your mic. That's been done for you. The webinar is being recorded, and so after the fact, what I'm going to do is send out an email to everyone, all the registrants, and you will receive that, and it'll have, that'll probably be later on this evening, got a little processing to do there, but what it'll do, it'll also have the slides for you to download, as well as if some instructions if you want to follow back up with me or with the team. And then during the webinar, we want to hear from you. So please ask questions on your attendee control module. You have a space where you can actually ask questions. So do that there rather than in the chat. It'll be a little easier for us to find. But please ask your questions at any time. You don't have to wait until the Q&A in order to do so. And we'll get to as many of those as we possibly can today during the allotted time. If we're not able to get to yours, we will reach out via email afterwards and make sure we answer your questions. So please, we'd love to hear from you. So without further ado, I would like to introduce our speakers today. Leon Chernyavsky, who's the managing partner with Allianz Healthcare Capital. And we also have Ben Rutkovitz, who's the VP of Business Development, also with Allianz. So I believe Leon's going to kick us off. So welcome, gentlemen.
Thank you so much, Garrett, and thank you so much to the exhibit hall for having us run this webinar. We'd like to start out by just discussing a couple of items, why it's necessary for an ACO to have financing or DCE. I know DCE has been a hot topic lately, and it's a new program that everyone's excited about. So we're able to work in that sphere as well. So the main thing is a lot of these risk-based programs, they get paid once a year. So it's important for them to maintain, to have access to working capital so they can maintain their staff, keep the lights on, etc. In the DCE space, the capitation payment or the admin fee is paid monthly, as many of you will know, but it may not be enough to fulfill a certain growth plan. Additionally, I know in the DCE space, there's a CMS benchmark guarantee that is required, and that at times is difficult for some of these entities to receive. Or they may need to put up a decent amount of collateral for an surety bond, or have to bring a lot more equity to the table. And lastly, we think, and I think from speaking to many people in the field, that it's a capital intensive business. There's a lot of overhead. There's staff and team case management. There's data delivery and informatics, which are really the core of a successful ACO or DCE. So as a result, this topic we think is very important, and we hopefully will provide some guidance to you as to what options are available and where you can go to get them. Before we dive in and introduce ourselves, we'd like to have a polling question. And the first one is, how would you classify your organization? We'd like to understand our audience here. Are you an ACO, DCE, consultant, or other? So Garrett, I'm not sure how you run the poll, so maybe you could let everyone know.
Yeah, he put it up.
Yeah,
so
it's up. So you just
you did? Great. Okay.
Yeah. So
It'll take
we'll
a
give you
second.
guys like 15, 20 seconds to go ahead and answer that.
Okay, I think all the responses have come in. Would you like to see the results?
Sure.
Do I need to close the poll here on my screen?
No, I'll do that for you.
You'll do.
Okay, we see the results now.
Okay, great.
Interesting. Great. Well, I think this webinar is going to be informative to most people on this call. Leanne, you want to go to the next slide?
Yeah.
Yeah, Garrett, close the poll. Great. Okay, well, great. Leon, thank you. Garrett, thank you as well. And everybody, thank you for your time being on this call. My name is Ben Rutkovitz. I'm going to introduce Leon and then he'll introduce myself. Leon, just a side note, looking at these pictures, I definitely think we need updated ones.
I think they're about 10 years old at the minimum, I think, yeah. Right?
These are before kids, when we were all...
when we had some sleep.
Yeah, when we had sleep. So Leon is a managing partner and co-founder of Allianz. Obviously, he's been around since Allianz's inception back in 2009, and he believes that lending needs a human touch and must make a difference for the client. Before Allianz, Leon ran a hedge fund in the commercial real estate space, and Leon's hobbies include tennis, DJing house music, and making borscht for his children.
Thank you, Ben, for that introduction. It feels as if you've known me for a majority of your life, which if the audience would really like to know. Ben and I went to high school together, so we actually do know each other fairly well. So Ben has been with Allianz also since the beginning. He runs the business development team. He's very instrumental in Allianz's origination efforts. Prior to that, he was a business development officer at a bridge lending hedge fund. And in his spare time, Ben loves to meditate and can make a phenomenal shakshuka.
Thank you.
A little bit about Allianz, in case any of you are wondering. We've been operating since 2009. We're a specialty finance company with a main focus on the healthcare space. We work with medical providers, ACOs, DCEs, IPAs, and MSOs, and everything in between. We funded over 200 providers since inception and deployed over $500 million. In terms of the products that we've offered to our clients, we can get very creative, but the core products are AR line of credit, term loans, and special situation loans.
Okay, so we have another polling question to get to know the audience better. Thank you, Garrett. So for ACO DCE participants, what is your organization's ownership structure? Privately owned, hospital affiliate, private equity backed, physician owned, or other, unsure. And I suppose if you are a consultant or non-ACO DCE, you can leave it blank or put other. Either one is okay. And we'll give you about 15, 20 seconds to answer.
Okay, looks like we got most of the results in. Would you guys like to see the
Sure.
the answers here?
Absolutely.
Great. And Garrett, would these polls be available in the recording as well?
Yeah, they'll be in the recording. So they may not be in the slides that we send out. It'll be the question, but not the results. But the results will be here in the recording.
Okay, wonderful. Okay, you can close this out.
All right, has everyone seen the next slide now?
Yes.
Okay, excellent. So we'll dive into the presentation a little bit more. There are a few options that are available for ACOs and DCEs. The first one, the way we see it, is the traditional banking option. The pros and cons of each. For this particular option, the pros are you have a local or national bank that has a big footprint in your local area. The interest rate that these banks charge are typically lower because they're tied to maybe a LIBOR or a prime rate, and you know it's a trusted partner because you see them as you're driving down the street, or it's a big organization. However, with those positives, there are always some negatives. Banks typically have strict requirements or covenants in their loan products. They want you to have additional collateral, an example, real estate or something tangible that they can use in order to provide financing for you. The process for approval as well as funding on an ongoing basis can be lengthy and perhaps bureaucratic in some of these traditional banking institutions. And from a financial standpoint, they require minimum years in business, typically 3. They want you to have positive EBITDA, and they want to do business with companies that they see are strong candidates to receive loans from them. The biggest con that we see with traditional banks is that they are tied into their lending box, and it takes a lot for them to understand esoteric strategies. And with ACOs and DCs, obviously there's a lot of detail and a lot of agreements that need to be understood. So the biggest con that we see with the traditional banks is that its inability to understand risk-based agreements, which is the core of any ACO or DCE model.
Continuing on the financing options, the second one is a non-bank asset-based lender. And the pros are that this non-bank lender is specialized in healthcare. So the lender understands medical accounts receivable, revenue cycle management, and most importantly, risk-based agreements. In our experience within healthcare, for a lender, risk-based agreements is one of the more complicated things to wrap our heads around. And so the fact that a medical lender who specializes in the space can understand it is probably the biggest pro compared to the bank, the traditional bank. Some additional pros are that the terms are flexible and covenants are light to very light, especially compared to a traditional bank. The due diligence and closing process is quick and speedy and a lot less burdensome than with a traditional bank. You're usually looking at about a 3-week process where banks could run several months or more. Younger companies and companies that don't have positive EBITDA can qualify with a non-bank asset-based lender, and this type of lender is also okay with credit blemishes. Some of the cons are the pricing is going to be higher than a traditional bank, and the entity is less of a well-known entity than your typical Wells Fargo, Bank of America.
The last option that we want to bring forth is the equity option. Obviously, everyone has that option. It could be your rich uncle or an institution. It could be someone that can help you with their business. So the pros of an equity provider is there are a few pros. Some of them we'll be highlighting. It could be a strategic partner that's focused on growth. It's someone that understands the business and wants to be involved and see the business grow. It could be very, very helpful for some of these institutions. The other pro here is that there's typically no interest expense from an equity investment, which leads to a higher cash flow and can be very helpful during the early stages of the life of an ACO or DCE. The flip side to that is that there's some cons. Equity is the most expensive option out of all the financing options we brought forth. The partner you bring on may have a different time horizon for an exit. Some private equity or venture funds have certain timelines that they have to exit their trades in order to meet certain hurdles within their fund. When it comes to due diligence, it's typically a lengthy due diligence process. It's hard for me to tell you how long it takes because it's really dependent on each of these equity providers. But typically, 4 weeks to possibly 12 weeks is something of the norm. They could potentially have unfavorable restrictions for management or founders. They could limit the amount of salary the manager or the founder could take, or some kind of distributions. And from a private equity standpoint, when they look at some of these ACOs and DCEs, they want to see a certain size from the get-go and want to know that the scalability of this business is there. So for that, they need to have some track record. And if you don't have track record, you may have slightly unfavorable terms. But our experience has shown that the more track record you have, the more favorable the terms could be.
So we want to go over a case study, a group of value-based organization that Allian has funded in the past. And to keep confidentiality, we're just going to give an overview of the organization. So this was a nationally recognized value-based healthcare organization operating in multiple states. Under its umbrella, there are 5 ACOs with over 500 participating providers. The ACOs were participating in CMS's MSSP program and came to Allian initially looking for a $15 million line, kind of speaking to what Leon was talking about earlier, because their major payment came once a year, and they knew that if they had funding throughout the year, instead of waiting for that payment, they can grow the number of lives, number of patients that they took care of exponentially. And so that's why they came to Allian.
I think it's important to give you a pretty general explanation of how we structured this deal. This was an asset-based line of credit. We looked at the business and we figured out, what the projected yearly savings was, which was with the minimum savings rate times the assigned patients times the PMPY expenditure. We then looked at the cumulative minimum savings. It was a formula that we used to figure out what that is, which was the projected yearly savings multiplied by 25% for the first quarter, 50 for the second, 75 for the third, and 100 for the fourth. The projected actual quarterly savings were then pulled from CMS, and we were able to match them up to some of our estimates. We implemented what was called a variability discount, which was the difference between the final number and the fourth quarter number, and as well as a quality rating discount, because some of the CMS uses that to reduce its payment, and came with what we call an estimated collectible value, which is you take the 100% value of what's expected minus all those discounts, and you get a value of what you think the ACO is going to receive on a yearly basis. We then created a tiered advance rate based on all of these measures to make sure that we were in line with our estimates, and it's better explained within the next slide. So I'll let Ben handle that.
Yeah, so these are some estimates, putting numbers to paper from the previous slide that Leon was referring to. And so the projected annual savings were started at 45 million on the first quarter and 48 million by the fourth quarter. And then so the net amount to the ACO before any of the discounts was 50% of it, 22.5 million in the first quarter, 24 million by the fourth quarter. Then we took off the benchmark variability discount and the quality rating discount. And just something to reiterate what Leon was saying, this was based on the historical data for these particular ACOs. So in some cases, the numbers could be different, could be higher or lower, depending on a particular ACO. But taking out these discounts, we ended up at the estimated collectible value that you see there, ending at 10.8 million on the fourth quarter. And we advanced, we ramped up our advance rate, starting at 60% quarter one, ending at 90% on the fourth quarter. And the last column, you see the borrowing base availability for this particular client.
And just to touch up on this a little bit more, the borrowing base, although it started on the low end in the first quarter, as the year progressed and as the certainty of the shared savings became known to us, we were able to increase the advance rate and give more availability to the client going forward, which was very helpful. And the client actually really was very appreciative of the fact that they can borrow more if needed. Some clients borrow more, others don't. This particular client was borrowing on a monthly basis based on its availability and only on what they needed. So we discussed non-bank lenders being flexible and being able to work with each client on a case-by-case basis. This is one of those examples of how we're able to structure deals that really fits into the client's view. So I think it's important just to give you a very general understanding what the process could be like. A transaction usually comes to our door through any one of our intermediaries or any business development officers that have reached out to a potential client. They'll do an initial call. You'll possibly have a couple of senior partners on the call as well to understand the business, to get a better sense of who we are, to better understand who the client is. Once there's some information that's been discussed on the call, we'll likely want to get more information from a potential client. And before we do that, we sign an NDA or any kind of HIPAA forms to protect everyone, and ask the client to put together an application, which is a web-based application that's on our site. With the application, we typically ask to see some collection history, some benchmark variability and quality rating scores, some information that will help us really kind of get the high level, a little bit more than a high level understanding of the client. Once we get to that point, we issue a term sheet. In the term sheet, we'll discuss all the terms of the potential transaction. The client can ask us as many questions as possible, and we'll answer in a timely manner. And then once we agree on the term sheet, it's executed, and we go through the full due diligence stage, which involves third-party background searches. These are lien searches, background checks. We want to make sure that the business is in good standing, that there aren't any lawsuits or serious lawsuits. We're okay with some blemishes here and there, or some unrelated issues having with the business. I mean, every business goes through ups and downs, but we're really looking for fraud or any kind of insurance fraud or serious, serious notches, negative notches, so to speak. In underwriting, we put all the data together that we received. We were able to model out the correct pricing, or the correct estimated collectible value. After that, we present it to the client. We let them know, here's what we think that this should look like. They're happy to add additional information if needed. And once we all agree, we go into legal, and then the attorneys take over to finalize the documents. The process from start to finish, that's from the initial call to about funding, typically takes about 3 to 4 weeks. It really depends on the client's ability to provide the necessary information and how much the client is able to, how quickly the client is able to get that info. So in a nutshell, that's our typical process. Obviously, with each client, it could be slightly different, but these are the general terms. And I think we're now up to the Q&A section. So if you guys have any questions, we'd be happy to answer. We didn't want to bombard you with too much information. I wanted to make this very succinct and really just answer any questions you may have. So with that, Garrett, maybe you can let us know if there are any questions.
All right. Yeah, we do have some questions, so let me pull those up here. And by the way, this is a great discussion. Give me 1 second here. For some reason or other, my little question thing is missing. Here we go. The first couple questions that came in, there's sort of from two different users, or two different of our users of our audience actually was the first, and they kind of go together, is and this is directed at Ben, is what is a shakshuka? And then the second follow on was, what makes Ben's shakshukas superior to others?
Two very good questions. I would say if you haven't had a shakshuka, definitely you're missing out. It is an Israeli omelet, basically, with tomatoes and onions, usually spicy. Depends how you like it. And I think Leon would be able to answer this better than me. I think what makes mine mean is the jalapenos I put in it.
That's exactly what I was about to say. It's the spice that makes it really potent.
Good question.
Awesome.
Thank you.
Yeah, good questions.
I'm glad the audience has a sense of humor. I mean, these are boring most of the time.
Yeah, no, for sure. They were very interested in that. Okay, getting into some other ones. And these are in no particular order here. Does Allianz need to satisfy the Dodd-Frank requirements like banks?
No, as a non-bank lender, we don't have that requirement.
Yeah. Next question is, how many years of experience on which you ran your pro formas did the 5 ACO case studies have, and do you fund startups?
Sure, it's a good question. For this particular case study, it was 3 years of experience, and the answer to whether we will fund startups or not, we typically like to see some history. The only way we do fund a brand new startup is if we get comfortable with the management team. Maybe the management team that ran an ACO for a previous entity is starting out and they need some financing, we would be interested. But if it's a brand new entity without any kind of history, it's a little difficult for us. We'd like to see at least 6 months to a year of history before funding new clients.
I will tag something on top of that. For DCEs, obviously, they're all going to be brand new. Yeah. And so we are looking at several DCEs right now where we're considering funding their guarantees. Is that what it's called? Is the CMS requires a guarantee?
Yes.
So providing a line of credit to the DCE based on the guarantees. And so my big takeaway from this is, if you're not sure, if you have questions, it's always worth to have a conversation with us because we can get creative and make things work if the management team and the company is right.
Correct.
Okay, great. Next question is, do you have a range of deal size? Allianz, let's see, I don't know if I'm reading this correctly. Do you have a range of deal size Allianz Finance? I guess, a range of deal sizes that you finance.
Sure.
Does that
Sure.
make sense?
So I can start and Ben can add if he needs to. Our typical range is between 1 million and 25 million. We can go higher than 25 million, but once we go higher, we typically syndicate the transaction with some of our partners. So in short, 1 to 25 is what we like to keep in-house. Anything above 25, we syndicate.
Yeah, and just to clarify that, we're looking for that to be the facility size,
Correct.
right? So that's how much we're going to be lending to the client.
Correct.
Gotcha. Okay, and then next question here is, can you confirm that by asset-based, you mean against AR?
Confirm.
Okay, that was an easy one. We got a couple more here to go through. What do you use as collateral for your ACO or DCE loans?
So in the DCE space, obviously it's still fairly new. And what we're looking at right now, we'll take tangible collateral if there is one, such as real estate or equipment, etc. But more than likely, that's not the case for some of the clients. What we're using for DCE space, we're doing the capitation payment that they receive on a monthly basis as collateral to help with meeting the CMS's guarantee parameters. In the ACO space, we use the accounts receivable as collateral. So it's the payment that they're going to receive from the MSSP program or any other value-based program. We use that as collateral to provide the loan to the client.
Okay, great. Next question is, would you consider lending to providers of an ACO?
Absolutely. We lend to providers now. If you recall, Allianz focuses on the healthcare space as a whole. We started out lending to medical providers, individual medical providers, doctor groups, assisted living facilities, skilled nursing facilities, diagnostic labs, I mean, you name it. Anything that bills third-party insurance carriers, we can take a look at. That is our mandate. So we would be happy to take a look at the underlying providers of an ACO.
Okay, great. And then let me know if you already answered this question, but what is the minimum / maximum size of your loans and terms? I know you touched on that earlier.
Yeah, so in terms of size, we're looking at 1 to 25 million. In terms of term, we typically are between 1 to 3 years, with opportunities to extend the loan. So we have some providers use this as a bridge loan, just a short-term fix to get to the next stage, and we've had some clients that have been with us for going on 10 years.
Okay. Next question, just to clarify, so it's the heat rather than a unique spice that makes the shakshuka special. Is that correct?
Correct.
Okay, good. Then the last question that we have time for today here is, your process is similar to that followed for purchasing reinsurance? And a second add-on question, which may be separate, is do you integrate your process with that of reinsurers to minimize duplication of providing documentation?
So we're not familiar with the process of reinsurers. We haven't. So I guess the answer to the second part of the question is no, we haven't integrated it. It doesn't mean that we can't, but at this point, it's not something that's come up with any of our potential clients. So I'm not sure how to answer that question.
Okay. Well, I hate to end on that one, but that's unfortunately all the time we have for today. Thank you guys so much for the presentation. I felt like this was a very valuable and insightful look at financing. As we close out here, I wanted to encourage everyone to visit the Allianz Healthcare Capital exhibit booth at ACOexhibithall.com. And could I get you actually, Leon, to go to that slide?
Absolutely, yeah.
All right, cool. So you can kind of see here what that looks like, and if you go there, you can learn more about them, interact with their team. We'll have a link to the recording of the webinar there, as well as some other information, some interviews and things. So definitely encourage you to check the ACO exhibit hall out. And then finally, if you would like to get in touch with either of our presenters today, their contact information is here on the screen. So feel free to reach out to them, or if you need to reach out to me, I'm happy to set up an introduction. So thank you all again for joining. I know there's a lot going on, a lot vying for your attention right now. So we really appreciate your time, and hope that you have a wonderful rest of your days. Have a good one.
Bye.